Hello, I'm Bernard Hickey from interest.co.nz and welcome to another in our series of double shot interviews here on interest.co.nz, where we speak to a minister or a chief executive or someone who's doing something interesting in the economy, the housing market, the investing scene, to find out what's going on. And today we're here with Matt Whineray, the General Manager of Investments at the New Zealand Superannuation Fund. Matt, welcome to interest.co.nz. Thank you very much for coming in. The reason I was keen to talk more about the New Zealand Superannuation Fund is this big issue we're debating nationally at the moment about how we connect New Zealand savings with New Zealand investment opportunities. And obviously the New Zealand Superannuation Fund plays a big role in that now. And I'm curious to know how the New Zealand Superannuation Fund is funneling its cash, the money that does put into New Zealand investments. Can you give us an idea of what mechanisms you have there at the moment?
Sure. Well, thanks, Bernard, and thanks for the time. So we currently have roughly around 20 to 30% of the fund in New Zealand, depending on how you count cash. So we have big cash holdings, depending on whether you count those, it's closer to 30, otherwise it's closer to 20. We have a mandate that requires us to maximise returns without undue risk, but we also have a directive from the Minister from about 18 months ago that asks us to actively identify and consider New Zealand opportunities. So we have a number of strategies that look to that. Where we're looking in New Zealand is, under those strategies, is in really sort of four areas. We have existing exposures in New Zealand, so I'll talk about those briefly. We've got large timber holdings. Kaingaroa Forest is our largest holding in the whole portfolio. We have property investments via a wholesale AMP run fund. We have New Zealand listed equities, which we run both passively and through some external managers, and those are our existing NZ holdings. And within that are big chunks of domestic listed vehicles like Auckland Airport, Fletcher Building, Contact, Telecom, etc. The new strategies that we're looking at are fourfold, and those are really looking for spots where we think there is a capital shortage, if you like, and so the opportunity is there to be able to get in and generate better than market returns from.
Because there is this sort of no man's land at the moment in between the really big companies and the really small ones, where they are often saying, I'm struggling to get New Zealand capital here. I often have to sell out to an international company, or I don't have the capital to grow. How do you get into that no man's land? It's
a tough one to get into, and that's one of the strategies we have is what we call the expansion capital strategy, and that's aiming at those companies that are, call them $20 to $50 million in size. They need capital in the sort of the $5 to $15 million range, and so they're established businesses. They've got existing operations, positive cash flow, but they need to get through that flat patch. They've used up all of their friends, family, bank credit supplies. They haven't quite got the size to get to the listed markets, and you see that manifest itself in some companies that go, we think, a little early. So it's a hard place to get into. The reason there's not a lot of institutional money in there is because there's not a lot of access points. It's what we think of as sort of an empty room, which is one of the places that we like to find. So we've appointed, in that strategy, we look for external managers. So we won't look to build a team in-house to chase these types of investments. We think it's an intensive process. You need a team that's very good at getting out and finding where these opportunities are, what we call origination, analysing them, and then managing and helping these companies to grow. So we've appointed one manager under that strategy. That's a domestic fund based up here in Auckland called Waterman Capital, and we'll continue to look for other investment managers to help us access that space, but it's not an easy space to get into.
And apart from those relatively small investments, because they're never going to be too big, they're going to be the sort of 5 to 10 million, not the 150 million or 200 million.
Sure.
How else do you put super fund capital into New Zealand business ideas or businesses?
Sure. We do that in two ways. We do it. Some of it we do directly, and some of it we do in what we call indirectly or through external managers. So we have a strategy that we call NZ Direct, and that's there to chase a small handful, maybe 5 to 7 in time, large investments in domestic enterprises. And so those, when we say large, we mean sort of $100 million up. So they will actually change that proportion of New Zealand versus overall portfolio that I talked about at the start. And those because of our restriction in our legislation that we can't control anything, will be partners in those. So we'll need big partners to partner with us as we look at those.
Can you give us some examples of where you've done something like that?
The one that's often used, which isn't actually an NZ Direct investment, is Shell. That's a little bit of a hybrid. So Shell New Zealand, now called Greenstone, is a partnership between us and Infratil, and it was managed by one of our infrastructure managers, Morrison & Co. That is the type of scale and type of structure of transaction that we will look at under this NZ Direct strategy, where the types of investment vehicles might be what Adrian calls the 3 Cs: Crown, collectively owned, cooperatively owned. And so we need partners that are going to be very long-term partners like us, and often that will be from within enterprises like that.
Because over the next 10 to 20 years, New Zealand is going to have to invest a lot in infrastructure, be it roads or hospitals or ports or prisons or whatever it is. How does the New Zealand Superannuation Fund get involved in those investments?
Well, that's another strategy that is part of our response to that desire for us to look at greater New Zealand proportion, and that's what we call what we're looking for there is small infrastructure, what we call small infrastructure. There will be in time potentially some larger infrastructure pieces that we can get involved in, but we think where the potential transactions in the near term, the next few years, will be small. And we've done that with, again, Morrison & Co. through a fund that Morrison & Co. have established and have raised some money from other investors. Other New Zealand investors can invest in those. And that's looking at small infrastructure. It might be things like hospitals, it might be things like building schools, or helping local authorities build water and wastewater treatment plants where they need some capital to fund those, or conference centres. And so the irony of that strategy, which is really focused on New Zealand, is that the first investment that has been made within that fund is a Melbourne-based convention centre. And that's because they're a little bit ahead of us in terms of the development of those PPPs. We're encouraged by some progress on the PPP front from Wellington and from the government through the National Infrastructure Unit, but we're really looking to find those sort of small to mid-size infrastructure opportunities to really access through that fund.
Now, the Superannuation Fund has, last I looked, more than $15 billion of funds under management, and only 20% of that, excluding the cash, was overseas. How much of it
in New Zealand?
In New Zealand, yeah. How much of that, what proportion do you think could be invested locally in the long term once you do these various things?
We think, in terms of those, we think in the small infrastructure space, maybe that's another 1% of the fund, maybe the expansion capital is another 1% of the fund. The direct, or there's one other strategy which is a global strategy, but will impact the New Zealand piece, which is rural. So that's where we'll look at farm ownership up to the farm gate. That's something that we can't get that type of exposure in the listed equity markets globally, and so that's one we'll look at. That might be 2 to 3% of the fund in the global strategy, so some smaller proportion of that in New Zealand. So that call that 3%, and then in the NZ Direct space, maybe you can do, between 5 and 10% of the fund. So what does that add up to? Call it 8 to a little over 10%. We could do under those strategies if we can find all of the opportunities that meet our investment hurdles. Just
to play devil's advocate for a moment, wouldn't it be easier and produce better returns just to simply throw everything or almost everything overseas into something, reduce your funds management costs by doing it overseas? How do you know that you're not damaging the overall performance of the fund by doing lots of little bits and pieces in New Zealand?
Well, whenever we do something away from what we call our reference portfolio, which is our low-cost passive one, we're doing something active. Every time we do that, we think very hard about what do we expect to get out of this versus what we know we're going to pay for it. That's the internal conundrum. You've got certainty of cost, and you've only got expectation of returns. We think so. That's why we look at those spaces where we think there are what we call empty rooms or fertile fields. where we think there are opportunities for managers to get better than those market returns and therefore improve the overall performance of the fund. We're not, at the levels that I'm talking about, we're not going to vastly change the risk profile of the fund, but we think that there are, within those spaces, those types of empty rooms, if you like, that we can generate better than market returns and improve the overall performance.
Great. Thank you very much. Matt Whineray, the General Manager of Investments for the New Zealand Superannuation Fund. That was another in our series of double shot interviews. I'm Bernard Hickey for interest.co.nz.